Well, the FOMC came and went today. The FOMC meeting announcement. Obviously, they did not cut interest rates, but they pretty much took rate hikes off the table. They had previously been talking about risk being balanced in terms of to the upside and to the downside. But right now, they pretty much only see risk to the downside, right? Deflationary risk and unemployment risk. They lowered the growth outlook for 2025. They lowered the employment outlook for 2025, and they raised the inflation outlook for 2025. And so not necessarily the best conditions there, and it was really dovish, and the market responded favorably. Remember, the bull case scenario for this year is no cuts at all, right? And so if there are any cuts, especially starting in June, which is where they're kind of priced in right now, then that's the problem, right? That's what we don't want to see. But as of right now, the market's taken this first meeting here in March positively, and has helped us along our way up to that 5% green tag we've been expecting here by March options expiration. I'm going to break down what's driving the markets here today in response to the FOMC meeting, and then we'll take a look at our trade idea of the day as well, which is in the energy sector, which has been an outperformer lately, and of course we'll break down how good of a thing that is for the energy sector to be an outperformer. So let's go ahead and get started. Today is Wednesday, March 19th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we rallied again today thanks to the post-FOMC move, though we did come off the highs of the day. We still finished up 1%, but we were well off the highs of the day. That brings our total off the low point now up to 2.78%. So we were at, again, over 3% at the highs, well over 3% at the highs, but we're more than halfway to that 5% tag. And again, a follow through tomorrow and Friday probably could get us there, if not most of the way there. As I mentioned before last week, I talked quite a bit about getting a green tag before March expiration, and we might still be. I still think there's a really good chance of getting that. Let's go back to the market forecast chart. As you can see, and in fact, even if you take a look at the rate of change here over the last 4 days, we've had a 4-day rate of change. This isn't that big of a move to the upside, which might be one thing to keep in mind in terms of a good sign that this might end up failing, right? If I were to put this line here, let's put this at 2.78%. Whoops. Let's do it at positive 2.78%. Here we go. So you can see, on some of these moves, off of the correction low point, we had a 4-day rally of over 6%. And that one ended up failing. And you can see some of the other bounces, pretty much almost every bounce off of a low point, off an intermediate low point, bounces up more than this. The one off of this low point really bounced up quite a bit, over 5%. Obviously, the COVID drops, and even that pullback jump was a bigger move than this in 4 days. 2018, and you can see about the same level where we kind of failed. We didn't get a green tag here. We got the green tag right here, and we kind of failed. We only went up about 3% there, and then we fell back down, and then we got our move. But keep in mind that this one in 18, we weren't down to the 200-day moving average yet. We were here, right? So we stopped short of the 200 here. We got to the 200 there, and then rallied up to the 30, 50-day moving average, and again with not very much of a move, 3% plus move. So again, it's the kind of move that doesn't really stoke a lot of confidence into the fact that we're bouncing off these lows to new highs. It's a really tame bounce up to the upside. But the nice thing is, obviously, we're not bearish. So the near term line crossed 50 or crossed 60 to the downside. This is day one. It did not cross 50 or 40, right, which would have made it worse. And the momentum line actually finished higher, slightly higher, 0.02 of a point higher, but finished higher than the near term line. So that's, again, it needs to be lower, and ideally in the reversal zone if we're going to be like really bearish, and like again, like over here, like on this day right here. When we broke down, we were at 72, and then we were at 27. So we broke 60, 50, and 40, and the momentum line was extreme lows. I mean, that was a pretty good indication. I mean, nothing's 100%, but that was a pretty good indication that we were going to falter. We're not getting that kind of decline right now. So this is not the most bearish near-term drop, and most likely means that we'll bounce back up. I told you yesterday that the momentum line was likely to bounce out of the reversal zone, and now the near-term line is likely to bounce up back into bullish territory. And the question, of course, will be how bullish will it be, and will we get above this 2.5% mark, which we likely will. Again, as you can see during other corrections, when we do fail, we get that bear tag, right? Which is, we need to get that bear tag to really kind of solidify the correction bounce. We didn't quite get one here, but we got the yellow line and the light green shade. We didn't close above it. Strong near-term move, ironically, during that time. We did get above the 2.5% mark, and remember, to get a bear tag, you're going to be a little bit above it, and we were just a smidgen above it there. We just avoided the bear tag there because the intermediate line was only slightly lower there. Otherwise, we would have had the bull tag right there. We got the light green shading the next day. So, again, to get the actual bear tag, it's got to be light green shading and a yellow line with the close above the line on the same day. And so we'll see. It looks like this kind of decline does not look like it's going to drop to lower lows right now without getting to that 5% tag first. If I take a look at some of the other indexes, like the NASDAQ 100, here, let's go back to just a 1-year chart, sorry. Again, its intermediate line still in the reversal zone. Its near-term line did cross 60 yesterday. It also crossed 50 barely. But then we bounced back up. The momentum line's already higher. The near-term line did not get below 20. But remember, it's got to get below 20 on day 2, and obviously it's barely below 40. So not a bad sign at all. A good sign that we'll bounce off of this. The Dow, its near-term line still hasn't even crossed below 60 yet, so it's actually still in bullish territory. And then finally, your Russell 2000, it's the same thing, right? It just barely crossed 80. It's still easily in bullish territory, and it's not the strongest momentum bounce, but again, remember, this is in correction. The Russell's actually in correction mode, so its move off of this is going to be a lot bigger than normal, right? And remember, this is higher beta, so its boxes just have bigger numbers just in general. We had a 10% drop there. It's a 14% drop now. We're already almost up 5%, so it's going to get closer to 10 most likely, just because it's a correction. It's a move off during a correction. It's a bounce up during a correction, and it's higher beta just to begin with. Let's take a look at the weekly chart, because you can see we're really getting kind of a neutral candle here. It's a higher low point, right? So again, we got to get a upper shadow and a lower shadow to be a transition candle. So you're not going to get that here most likely this week unless we really take off. But it is a higher low, so that usually leads to a transition candle where you end up with a small body and an upper and a lower shadow, which means, again, depending upon how we finish this week, that we could have another pretty decent week next week. I mean, if it's not strongly bullish, at least bullish enough to produce a transition candle there. If I take a look at the 3 green arrow chart, we obviously don't have 3 red arrows anymore. We have the 1 green arrow. We're really close to a second green arrow. Same thing on the Qs. We do have both green arrows on the Dow and the Russell. But again, we have to get 3 to get the green shading, and especially get 3 green arrows and a green line, and we're not anywhere close to that, obviously. If you take a look at the 2-line version of this chart, we are above the 8-day. We're not above the 17-day. The MACD is above its moving average, which means now we're in convergence, right? We've seen this before. When you're bullish, when you're above the 17-day, but the MACD crosses down, we continue to grind higher. Well, that's the case right now. We're below the 17-day, but the MACD is above its moving average, so we're in convergence on the other side. We need to get above the 17-day, which also means we're going to get above the 200-day And for that matter, you'll most likely also be getting above, here, let me just zoom in here. Maybe that'd be easier to do. There we go. So if I draw the Fibonacci lines here, if we get above those lines, it also means we'll be getting above the 38% Fibonacci retracement, right? And that will be a significant move up to the upside, breaking above all those. I mean, those are multiple layers of resistance. And just for some perspective, like we won't get a green tag. There won't be a 5% close. Like if we close right on the line at 573.96, coming off of the close of 551.42, because that zigzags based off of closing prices, then it would just be a 4% gain, for just over 4% gain. So you're gonna, to get the 5, you're gonna have to get up above here into the 50, if not 62%. That's where your moving averages will be. So you're most likely going to get around 580 by the time it's all said and done on this rally. And I think we get above this either tomorrow or on Friday, and then we finish. We might get to that 5% number, but we probably will finish the move sometime next week, right? And that's where we get the transition candle as a result. Remember, to get a transition candle on the weekly chart here, we would have to trade above the Hakunashi Open, which is 577.01. So we're 10 points away from that, but that's what we need to get the upper shadow and turn this into somewhat of a transition candle here. If you take a look at some of the other oscillators, again, the same theme as what we've seen. They're not bearish anymore, but they're not bullish either. We're still above 25 on the positive, still well below 20 on the negative. If you take a look at the RSI and the CCI, we're still, we're above 40, so we're not strongly bearish, but we're not above 50 yet. We're not below minus 100 anymore, but we're not in the positive levels yet. So we're not really even weakly bullish on these oscillators. If you take a look at the Ichimoku cloud, we still have a mature bearish trend. We're above the 9-day midpoint. The 9-day range is midpoint, but we're not even close to the 26 days, and that's going to stay here because 26 days, the high, is like over here. So we still got a few days before we start bringing that high point down and shrinking, bringing the midpoint down. And the rate of change is clearly negative. The cloud is clearly pink, and we're still easily below it. So we're not even we want to be above it by the time we get there, and we're not even close right now to being above it. If you take a look at the Bollinger Bands and the Keltner channels, we are not in the lower quartile anymore, but we're not in the upper half either, much less the upper quartile. The momentum is rising, but it's still bearish, still strongly bearish, and the bands are moving towards the Keltner channels, but still way outside of them. So again, we've halted the downward decline, but we have hardly changed. This is not a V bottom, that's for sure. Not even close to a V bottom, at least as of now, and it doesn't look like it will be. We did get a higher high and a higher low. We closed above yesterday's high. We still finished the day below last week's high point, and obviously in the lower half of the range, you can see we're above the average, but still in bearish territory when you're comparing the close to the 4-week range there. Obviously, the rune indicator is we haven't had a low for a while, which is good, but we're also the high is still way over here, and it will just keep kind of dipping down. With the range having exceeded the 10% mark. So we've stretched the rubber band to the downside. Now, it's a matter of, whether we bottom. And again, it doesn't look like that's what we're doing. If you take a look at the volume and the trading range, again, the range here at 9 points. So we talked about this before the FOMC in class, that we're going to finish today, we're going to expand the range because the range is really tight. It's been tight the last couple of days. It was tight going in the FOMC. So most likely we're going to expand that range after the FOMC announcement. And we did, and the volume, it got up above average. So remember, for us to be strongly bullish to the upside, we need some strong bullish days, right? Above average days to really give us the escape velocity that we need to break the sentiment, which is strongly bearish. And we're not getting that yet. I'm barely above average, a little bit, barely below average, barely above average on the volume, and it's still rising. So, we're probably going to get to 2 before we set the low, right? Because remember, you get your biggest days below moving averages, and these are hardly big days. I mean, look at the daily price moves. You can see these. I mean, we're above 1%, but we've only had 2% gain, and that was coming off of that low point. But that's it. We need way more kind of days like this get off of that low point. And you can see kind of over here as well when we got off of that low point there, and we need stronger days than what we've been getting, that's for sure. If I take a look at the VIX is down below 20, so that's a good sign, right? We're flirting with 20, depending upon what time frame you're looking at. We're still in risk aversion territory here. You can see it's neutral and risk appetite down here. We're still risk aversion above the 95th percentile. But that VVIX has plummeted. That's a big drop in the VVIX. That's a very good sign for the market. So if there's anything that is working in the favor right now, it's that VVIX being as low as it is. And you can see when I look at the VIX relative to its average values, we're kind of sitting at an important level that we would really like to break down below. Granted, really need to get below the 200-day if you're going to feel good about, a bounce to new highs. But getting below 20 is a very important level, and just on an absolute basis, much less on a relative basis compared to where this has been, in these multiple time frames. All right, now let's talk about what's driving the price action. Of course, today we know what happened. It's the FOMC release. That hasn't changed some of the prevailing trends over the past 3 months. Gold continue higher, developed market stocks continue higher, commodities have been coming off of a low point, bonds also coming off of a little bit of a low point, the dollar continued lower, stocks are coming off of an extreme low for that, so that just continues to move. In fact, if I were to zoom in to this 4-day rally off of this low point, again, developed market stocks, emerging market stocks are doing just as well as U.S. stocks, and small caps are outperforming the Qs right now at 4% off of this low point. That has been outperforming most of the time, but it's really since Tuesday's drop in the Qs has really opened up a gap between the two. Bonds have been flat most of the time. The dollar's been flat most of this time, and commodities, you can see, have gradually kind of moved higher along with gold. And the dollar's been weaker, on the weaker side, and that's helped push gold up to the upside. If you take a look at gold here, it's really gone parabolic again, making another parabolic move. There we go. You can kind of see again, obviously getting 52-week highs, but I like to look at the DMI to kind of measure, the pace of the move. And let's look at the futures contract to get rid of the gaps. So you can see that, that ADX is starting to rise up again. The gold with the gaps, which usually, makes them, makes some of these lines higher when they're both up above 25. Well, the negative indicator you can see is way down again. The positive is pretty darn high, considering, and so you have, a pretty wide gap. That ADX is moving up pretty quickly. So, in other words, we're getting another parabolic run. In the short term, it's really parabolic. When you cut this RSI in half to look at the short-term move, your negative is below 10. Your ADX is almost above 40. Your positive is well above 50. So a very, very big time run in just a short amount of time. If you take a look at rate of change over the past, when you say this, you can even just say here the last 1, 2, 3, 4, 5, 6, 7 days, 7-day rate of change. That's a pretty strong run. You can see at 26 days it's not so much, but there's your 7-day rally again, right up with what we saw at the about this time last year, in early April last year. If I were to zoom out so you can get some context on here, it's not the most extreme move. We've seen some other parabolic moves in the short term, but still, it's a pretty strong move in the short term, especially when you consider we've already been kind of bullish here since the beginning of the year. In fact, if you look at the run that we've had, so let's go here. Let's do it this way so I can count the days. So really since, December 31st is when we kind of bottomed out and we started to make the move up to the upside. So right there up to this. This is 54 bars, so 53. It doesn't always count. You don't want to count the first day. If you look at the 53-day move off of that, so pretty much most of this calendar year plus 1 day, again, we're up almost 17%. And over that time frame, you can kind of see, this is one period where we had that kind of run, and then we went sideways after, dropped down to a negative return for 53 days. Same thing over here, spanning the end of 2022, early 2023, and again we went kind of sideways to down, and then again over here when we went parabolic in 2020, and you can see what ended up happening. So needless to say, it's a very strong run to the upside over a short period of time. And I'm not saying that it's peaking like today, or but when it does peak, like it will start to roll over, and it will coincide most likely with a low point being developed in the dollar, right? The dollar's broken its 200-day moving average, but you can see its MACD is crossed above its average. It's stochastically extremely low. So and when you look at the Euro US dollar, which is the biggest component of the dollar index, like its MACD is crossed down below its moving average. You know, it has also gone parabolic. It's made a huge run up to the upside, and it looks like it's running out of gas on that parabolic move. You can see that the positive indicator got above 40, the negative indicator is pretty low. We're way up above the moving average, like way up above the moving average when you look at this chart, which shows you that. We were, at the highest levels of the year, the past year. Well, now we're coming back down. You can see the short-term sentiment has crossed 60 and 50. The momentum line's not very high, so this might not be the decline. But once this really starts to drop, then that's when you're going to have a bigger. You probably again remember that this is the euro going up. So when this drops, the dollar's rising. That's probably when gold will peak on its little parabolic move that it's had here. And then finally, and just to keep in mind the relationship right now between, if you take a look at, again, the Euro US dollar as the biggest component of the dollar index. Well, let's go FXC. Let's see what it looks like here. Yeah. So this is the ETF that tracks the Euro US dollar. Right now there's a negative correlation, which means there's a positive correlation between the dollar and stocks, and that's not typical. So it might not last forever, and when the dollar starts to rally, if the dollar starts to rally off of a low point here, and that correlation goes back to being negative, then of course that will be another factor that will put some pressure on equities here on this nascent rally that we're getting here. And then finally bonds. Let's take a look at bonds and how they're doing. Again, bouncing off of a low point, back above moving averages. The MACD and stochastics are turning higher. So it looks like bonds have formed a low point and are bouncing and are going to continue this move. That it's really trying to get going and get off the ground and get above these moving averages and get started on the trend to the upside. Of course, if it trends to the upside, that's not a good sign for risk appetite, because again, the correlation between bonds and equities, which has been positive lately, is going back to being negative. And if I were to zoom out here and look over the past 3 months, you can see it's going back to being negative, bonds and stocks, which means we're more in a deflationary environment, which is interesting because inflation expectations are rising. But when stocks and bonds move in opposite directions, then that means there's probably more deflationary concerns right now in the bond market, at least, than there is inflationary concerns. Let's take a look at the breadth. As that's something we focus on too, and the breadth is positive again for a second straight day. It's a very, very good breadth here. Again, not above 35 yet, so it's not necessarily the greatest. And you can see during the failed bounce here, went positive over here as well, and never really got above positive 35. So we want to see a little bit more breadth than that. And again, we've looked at let's go to this one. The number of stocks above the 50-day moving average is slightly above 200, still below its average, but at least it's above 200. The number of stocks with the 200-day moving average still below 250, still well below the average. So they're off their lows, but they're not breaking up back above the levels that we need them to feel really confident about. And you can see even here, generally speaking, breaking down below the average here and bringing the average lower is bullish, right? That's kind of what we want to see. Like you can see it over here when we broke down, we really took off to the upside before it started to take off again because we got so low. Well, we're already below it, but there's not much downside here. And so that's a concern that like we never really washed out. There's so many stocks below their 200-day moving average. That's why we haven't washed out. And the net highs and new lows still haven't turned positive yet. Above their average, right above minus 100, but still hasn't turned positive or gotten above positive 100 to kind of change the dynamic, right, the narrative here. So we're still bouncing off as we expected, and nothing in this bounce yet suggests for us not to expect a failure here. Like everything is suggesting that we should continue to expect a failed bounce. We're not getting enough juice to say, oh, it looks like we're going to really take off here because this bounce has been so strong and so strong in the breadth. Not necessarily the case. Definitely not necessarily the case. Let's take a look at the sector rotation. I kind of had that chart up there, but let's take a quick look here at the sector comparison chart. Well, first let's take a look at the sector, the 12 grid for the different sectors. And the three at the top are the three big ones, right? These are the ones, the biggest sectors, the biggest weightings, clearly dark pink shading and red lines, and not even close to anything else. But everything else, I mean, look at energy and utilities. Those are our biggest winners. Everything else, light green, close to the moving, a lot closer to moving averages than these three. That continues to be the case, right? There's a clear rotation into these areas that we don't want the rotation to come into, because all of these ETFs, when compared to the ETF, their ratio charts with SPY, when they are going up, I mean, they're negatively correlated. Their ratio charts with SPY are negatively correlated to the S&P 500, the risk appetite. So we don't want them to go up. In fact, I was taking a look at this. This is the technology relative to energy. And look at it breaking down below its 200-day moving average. Let's take a look at the weekly version of this. Again, technology relative to energy, which is clearly positively correlated for the most part with equities, breaking down below the 200-week moving average for the first time since, again, early 2022. That's not a relationship we want to see. It's like when the markets are bullish when technology is outpacing energy. When it's the other way around, it's not so bullish. If I were to come back here to the long-term PPO, you saw the momentum here is starting to, it's been getting lower highs and breaking below zero. But you can see the long-term PPO is also crossed below its moving average. So clear, showing a shift here, a shift from this bullish trend line, and you can draw whatever trend line you want, in the wrong direction. XLK just continues to look very bearish here, whether you're looking at the weekly version where the 8-week now has crossed the 17-week, which that hasn't happened since early 2022 across to the downside. See, we didn't cross below this, the 8 didn't cross below the 17 down here in October of 2023 when we had that other 10% decline. But obviously it has now. So a clear breakdown in both these lines. In 2023, we were above the average, clearly above the average. The ratio was above its 50-week average, and we didn't have both lines below 100. Well, now we have both lines below 100. For the most part, we have had both lines below 100 for most of this past 6-7 months or so, as we've been below the ratio, the line that's rolling over. And again, like I said, not only is price below the 17-week, but now so is the 8-week is below the 17-week. Again, a clear shift in direction, whereas energy, you can see energy is, been sideways for so long and it's had a really good week, and the ratio chart is breaking above its 50-week with both lines close to being above 100, which again, we haven't seen that breakout above the line since 2021 into 2022 with both lines above 100, and that, and being above the average and starting to trend to the upside. During the first half of 2022, first 6 months, even though the S&P was in full-on correction mode, energy was doing very, very well, and it would have the potential of doing that again here. All right, that brings us to our trade idea of the day, and it's actually in that energy sector. It's Chevron, CVX. Let's take a look at its market forecast chart first. Obviously, you have dark green shading and a green line. Nice little breakout move here to the upside. The intermediate line crossing above 80. Strong near-term move up into the upper reversal zone into extreme levels. If you look at its weekly chart, we are in a golden cross environment. The PPO is rising. Good strong bullish candle here above its moving average down there at the bottom. So that's good. 3 green arrows. We obviously have 3 green arrows. Here we go. You can see 3 green arrows for the last 4 days, which is kind of a long run here. The MACD momentum is picking up more than it has. Over 1.5 times the average volume here today. From a 2-line perspective, we're breaking out above the value area, the 1 year, breaking above all these highs. Strong MACD, MACD and stochastics down there at the bottom. Let's take a look at some of these other oscillators. The DMI obviously is going to look pretty bullish. All of these are going to look bullish. Well above 30 on the positive, below 20 on the negative index. Taking a look at the RSI and the CCI. The RSI is above 60. The CCI is well above 100, above 150. Looking at the Ichimoku cloud and the trend strength indicators, we're just starting a new trend, a weak trend. We were well above the cloud and strong rate of change. And then finally looking at the Bollinger Bands and the Keltner channels, we broke above the upper band and above the upper Keltner channel. The bandwidth is rising, maybe a day away from crossing outside the Keltners with some positive momentum. So what we decided to do here was to do a bullish trade, obviously. Let's come down to April. So we sold. There wasn't really a good vertical spread. I wanted to do a short vertical. We didn't have a good strike to do it on. So I went out to a relatively higher probability to that 30 delta, selling that, buying the 48. So that gives me about a 1.5 to 1 reward to risk ratio. So about $600, getting 900. That ends up being 1.5 to 1. So not bad. A lot of flexibility for timing, and again, it has to get above 170, and 170 obviously would be new 52-week highs for this if we were to break out and continue this trend to the upside. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.